In this module, we are going to cover two approaches of stock picking. The first is the investor approach and the second is the trader approach. In this video, we will be covering the investor approach, and in the next video, we will be covering the trader approach. Rational investors purchase stocks with potential to appreciate in the future. The approach that is useful in this is called fundamental analysis. The core idea is to enter stocks that are undervalued in order to gain from price appreciation. The other core idea is to exit stocks that are overvalued in order to prevent losses from the price fall. Before purchasing any stock, it is important to keep three primary things in mind. The first is fundamentals of the company whose stock you're going to purchase. The second is prevailing economic conditions in the countries that this company is operating in. And the third is the position of the industry and the industry performance in which the company operates in. The broad aim is to look at those factors that impact a company's present performance as well as future business activities. There are two primary ways of doing this. The first is top-down approach, where we first look at the economy broadly in general, then move towards studying various industries of our interest, and then finally look at the stock of individual companies in order to pick a stock or a company. The second approach is bottoms-up approach, where we first look at an individual company, then move on to look at the industry that this company operates in, and then move on and look at the broad economy in general. The core idea behind fundamental analysis is to look and determine a company's intrinsic value and then to look at how well its current market price is reflecting that. If intrinsic value is greater than current market value, the stock is said to be undervalued. If intrinsic value is equal to current market price, then a stock is said to be fairly valued. However, this is a very rare situation. If intrinsic value is lesser than current market price, then a stock is said to be overvalued. Here, it's important to note that intrinsic value is a subjective concept, and therefore, what may seem as an overvalued stock to you can seem like an undervalued stock to someone else doing the same course. Intrinsic value is something that is relative and is personal to you, as it is dependent on your view of that stock. Recall that the top-down approach of stock picking is when you begin your process of picking a stock by first looking at the larger picture. That is, you look at the broad economy, then you move on to studying various industries of your interest, and then finally you start studying the companies in these industries to pick a good stock. To understand this more in detail, let's take you as an investor who wants to pick a stock using the top-down approach. As we can now figure out, step 1 is to look at the economy in general. Generally, it's a good time to invest when the economy is in expansion phase. Consider that recently the government of India has announced increased investments and spending on infrastructure projects. This means and is a first clear indication that the government is in expansionary phase, and therefore you feel that a result of this announcement could be that private players operating in the infrastructure sector stand to gain out of this. Therefore, this gives you your first positive signal that 1, it is the right time to invest in the economy, And second, it is right time to invest in infrastructure players in the stock market. Step 2 is to study the infrastructure sector and various industries in it in order to conclude on an industry that you would want to invest. You come to know that the infrastructure sector has various industries in it, like engineering, utilities, cement, among others. From among these industries, you have to pick that industry which stands to gain the most from this government announcement. In the announcement, the government states that it is looking to invest in infrastructure projects that are based in Eastern India. While studying these industries, you realize that cement is one of the most localized businesses. This means that Eastern Indian infrastructure projects will need cement that has to be broadly purchased from Eastern Indian cement players. This instills more confidence in your study, and therefore you now feel that you should be investing your money in cement as an industry. And now, while going towards the next step of stock picking, you should look at those cement companies that have manufacturing facilities in Eastern India. Therefore, at the end of step 2, you conclude that cement would be a good industry to invest due to its localized nature and the government impetus on investing in infrastructure projects in Eastern India. The last step of this approach is to pick a company from the industry that you have selected whose stock you would like to purchase. As you know, and as you can recall from the previous section, you decided now to invest in Eastern Indian cement companies. These are those companies that have manufacturing facilities in Eastern India to take advantage of the localized nature of the cement business and the government impetus on infrastructure projects in the East. While conducting your study further, you came to know about two cement players which have significant manufacturing facilities in Eastern India and serve Eastern markets. The first is Shree Cements, which has a manufacturing facility in Aurangabad in Bihar to serve Eastern markets. And the second is Star Cement, which has a manufacturing facility in Guwahati, Assam and Lumshnong in Meghalaya to serve Eastern markets. While comparing these two companies, you take advantage of two tools. The first is a subjective company analysis. This is similar to the research project that you are doing on Finlatics, which includes studying the company's management, studying the company in way of a SWOT analysis, which picks up the company's strength, weaknesses, opportunities, threats. The second way in which you will compare these companies is a ratio analysis of its financials as well as its operational efficiency. Using the tool of company analysis similar to a research project and ratio analysis that we had covered in the previous modules, you come to know that Shree Cement is in a better position both from a company, financial and operational standpoint than Star Cement. Therefore, you conclude that you would want to now invest your hard-earned money in the stock of Shree Cements Limited. This concludes your top-down approach of fundamental analysis. The second approach of stock picking in fundamental analysis is the bottoms-up approach. In this approach, you first look at a company, then you look at the industry or the sector that the company operates in, and then you move and look at the broad economy or economies that the company is operating in. To understand this more in detail, let's take you as an investor who wants to invest money by studying or by using the bottoms-up approach of investing. Imagine you recently read in the newspaper about Tata Consultancy Services or TCS. There is a management change that is going to happen in the company, and you feel that this is going to positively impact the performance of the company. Now you set out to learn more about TCS. You do two analyses on the company. The first is a subjective company analysis, which includes looking at its new management, its strengths, weaknesses, or SWOT, similar to your research project on Finlatix. And the second is ratio analysis, where you look at its financial as well as operational ratios, look at its stability of finances as well as stability in performance. After conducting these two studies, you are confident that TCS is sound, is going to be run by a good management, and is also sound on both financial as well as performance parameters. This gives you your first bright indication that it would be a good time to put your money in TCS. The next natural step in your bottoms-up approach of study would be to study the information technology industry or the technology sector in which TCS is operating. To conduct this study, you would be comparing TCS with other peers or rivals that are also present in this sector. Some companies that are present in this sector are L&T Infotech, Wipro, Infosys. All three companies that mentioned here are listed, and so is TCS. Therefore, you would do a similar company as well as ratio analysis that we spoke about earlier on these three companies. And you will compare the result of this analysis with the result that you got while analyzing TCS. An example of such a study would be that you compare the 3-year EPS or PE of these three companies with TCS to find out the trend in which all four are going or have been going. After studying these three companies in detail and comparing them with TCS, you realize that TCS is well positioned as compared to its rivals. Therefore, this further strengthens your resolve, and after step 2 of bottoms up approach, you are even more confident that it is a right time to invest your money in TCS. The last and final stage of bottoms up approach of investing is to look at the economy. The economy study for a company like TCS can be slightly difficult as it operates in multiple markets. Therefore, you take three markets which are primary in terms of geography for TCS. The first market that you take is United States, the second United Kingdom, and third India. While studying these three economies or markets, you can do a PES analysis of the three. The PES analysis includes first a political analysis on the government's stability in these markets and the government's outlook on business. The second is an economy analysis, which includes the growth rate that is faced by these markets and the growth of the IT industry in these markets. And the third is a societal study in which you can look at the society that is present in these markets and its adaptability towards technologies offered by TCS. If you feel that all three parameters are bright enough, then you can go ahead and purchase stock of TCS. This would conclude a bottoms-up approach of fundamental analysis where you purchased TCS or did not purchase TCS as per your final outlook on the economy of these three countries. It is important to note that all fundamental analysis is unique to you and opinions on the same stock can differ with your peers.